Welcome back to the show. Today, we are performing a forensic audit on one of the most heated debates in the Australian property market right now. Everyone is talking about Melbourne. There's a narrative building, a very seductive narrative that goes something like this. Melbourne has been beaten down. It's cheap compared to Sydney. It's lagged behind Brisbane and Perth. Therefore, by the laws of physics, it must snap back. It's time to buy the dip. On the surface, that sounds like sound investment strategy 101. Buy low, sell high, right? But today, I'm going to be the one to pour a bucket of ice water on that enthusiasm. But we're not here to talk about feelings. We are here to talk about your financial survival. The reality is, if you do not understand the mechanics of why Melbourne is cheap right now, and if you do not calculate the true cost of holding an asset there, entering this market in 2024 or 2025 could effectively assassinate your property portfolio. Today, we are going to move beyond the headlines. We're going to look at the Melbourne Paradox. We will dissect the government policies that are actively repelling capital. We will run the terrifying math on cash flow. And we will answer the ultimate question. Is this a recovery play, or is it a value trap? Let's start with the psychology of the market. I see two distinct tribes of buyers circling the Victorian capital right now. The first tribe is operating through an emotional filter. We call this the prestige premium. Melbourne and Sydney have always been the twin pillars of the Australian dream. Internationally, they are the heavyweights. For many investors, owning a Victorian terrace in a leafy Melbourne suburb isn't just an asset, it's a status symbol. It feels safer than buying in a mining town or a regional center. There's a sense of pride that says, I own property in Melbourne. These buyers are driven by sentiment, often ignoring the balance sheet because the emotional payoff of the purchase is so high. Then, there's the second tribe. These are the contrarians, the number crunchers. They look at the charts and they see a flat line. They see that while Perth has rocketed and Brisbane has boomed, Melbourne has essentially gone nowhere for 5 years. They look at the population data, which is still exploding, by the way, and they see a dislocation. They think the gap between Sydney and Melbourne prices is at a historic high. This gap has to close. And to be fair to them, fundamentally, they aren't wrong. If you look at a 20-year horizon, Melbourne is undervalued right now. It is likely at the bottom of its cycle. But, and this is a massive but, being right about the direction of the market is useless if you are wrong about the timing and the cost of waiting. Let's look at the data. As of mid-2024, Melbourne housing values are actually still down about 3.4% from their peak 3.5 years ago. In a 5-year window, the total growth is sitting at a meager 15.6%. When you factor in inflation, which has been running hot, real estate in Melbourne has actually lost value in real terms over the last half-decade. It has performed worse than almost every other capital city, perhaps only rivaling Hobart in its sluggishness. So, why is this happening? Why is a city with world-class infrastructure and massive migration bleeding momentum? We have to talk about the elephant in the room, which is the Victorian state government. Real estate does not exist in a vacuum. It exists within a legislative framework. And right now, the legislative framework in Victoria is arguably the most hostile to property investors in the entire country. During the pandemic, Melbourne endured the longest lockdowns in the world. That left a scar psychologically and economically. But what happened next is what is really hurting the market. The state government, facing massive debt, decided to turn property owners into a piggy bank. They introduced rental reforms that significantly tipped the balance of power. Now, don't get me wrong, tenant rights are important. But for an investor, the pendulum has swung so far that it has introduced massive operational risk. The minimum standards compliance requirements have forced landlords to spend thousands on upgrades, heating, locks, electrical safety checks, often on properties that were already functional. Then came a tax grab. The land tax threshold was lowered significantly. This was a direct hit. Previously, you might have been exempt if your land value was below a certain point. Now, almost everyone pays. And they didn't just lower the threshold, they increased the rates. This is effectively a wealth tax on providing housing. When you combine higher maintenance costs due to regulation with higher taxation, you erode the profit margin. This is why we have seen a mass exodus of investors. They aren't selling because they hate Melbourne. They are selling because the numbers no longer make sense. They are taking their capital to Queensland, to Western Australia, or even to the stock market. There is also a livability crisis that we need to acknowledge. The headlines regarding youth crime, break-ins, and home invasions have spooked owner-occupiers. When you have a perception, whether fully statistically backed or not, that a city is becoming less safe and that self-defense laws are not in your favor, it drives people to the outer suburbs or to different states entirely. This softens demand from the very people who usually drive prices up, the families buying their forever homes. Now, I want you to grab a pen and paper or just visualize this with me. We're going to do the math. This is the section that usually stops enthusiastic investors in their tracks. Let's say you buy a standard investment property in Melbourne today. Let's call it a $1 million asset. You put down your deposit. You take out an 80% loan. So you have an $800,000 mortgage. Right now, interest rates are hovering around the 5.3% mark, give or take. That means your interest bill alone is significant. Now, let's look at the income. The rental yield in Melbourne is hovering around 3.7%. That is historically low compared to the cost of debt. On a $1 million property, a 3.7% yield means you're getting roughly $700 per week in rent. Now, do the subtraction. Between the mortgage repayments, principal and interest, the council rates, the insurance, the agent fees, and that punitive land tax we just discussed, which can easily be $2,000 plus a year, you are bleeding cash. In a principal and interest scenario, you're likely looking at a negative cash flow of around $2,700 every single month. Even if you switch to interest only to save cash flow, you're still likely losing nearly $2,000 a month. Let that sink in. $2,000 to $3,000 a month. That is $24,000 to $36,000 a year that you have to pay out of your own pocket just to hold on to this asset. That is a brand new car every year set on fire. Now the buy and hold brigade will say, that's fine. That's negative gearing. I'll claim it back on tax, and the capital growth will make me rich. This is the most dangerous mindset in the current economic climate. And here is why. It ignores the concept of serviceability and opportunity cost. If your goal is to own one investment property and you have a high income, sure, maybe you can stomach a $30,000 loss per year. You hold it for 10 years, it doubles in value, you win. But I'm speaking to those of you who want to build a portfolio. You want financial freedom. You want 3, 4, 5 properties working for you. When you go to the bank to apply for your next loan, the bank assesses your risk. They look at that Melbourne property. They see it as draining $30,000 from your income. They treat that as a massive liability because that one property is performing so poorly in terms of cash flow. The bank will refuse to lend you money for the second property. You become stuck. I call this portfolio paralysis. You own $1 million asset, but you are effectively handcuffed to it. You cannot expand. You cannot diversify. You're just treading water, waiting for a boom that might be years away. This is how portfolios die. They don't die because the property crashes to zero. They die because the investor runs out of cash flow or runs out of borrowing capacity and is forced to sell at the wrong time because life happens. Maybe you lose your job. Maybe you have a health issue. If you are feeding a hungry beast of a property $2,500 a month, you have zero margin for error. So is it all doom and gloom? Is Melbourne a no-go zone forever? Absolutely not. My personal view is that Melbourne is fundamentally a powerhouse. It is currently at the bottom of the valley. The downside risk is limited. I don't think prices are going to crash much further because they are already so suppressed compared to construction costs. We saw a glimmer of hope earlier this year. After the rate talks stabilized in February, Melbourne prices ticked up about 2.4%. It looked like the recovery was starting. But then, in the last 3 months, it stalled again. It's sputtering. It's like an engine trying to turn over in the cold. For a true explosion in prices, a catch-up boom, we need a catalyst. Markets don't just rise because it's time. They rise because of pressure. What does that pressure look like? Yield compression. Rents need to rise significantly to make the holding costs palatable. Interest rate cuts. We need the RBA to slash rates to lower that mortgage burden. Supply crunch. This is already happening. Builders are going bust, and new starts are at record lows. Eventually, the lack of new homes will collide with migration, and prices will pop. But here is the million-dollar question. When? Is it 6 months away? 2 years? 5 years? Sydney had a lost decade in the past where prices went nowhere. It happens. If you buy now, are you willing to bleed $30,000 a year for 5 years while you wait? That is $150,000 of post-tax income gone. That is a massive cost base to recover from. So what should you do? How should you navigate this? If you're an aggressive investor looking to build wealth now, you need to look at the concept of borderless investing. Don't be a postcode patriot. Don't buy Melbourne just because you live there or because you like the footy team. Look at markets like the Gold Coast. Look at regional NSW or even pockets of regional Victoria that offer better yields. Look at Perth or Adelaide. In these markets, you can often find properties where the rent covers the mortgage. Neutral cash flow, or maybe even positive cash flow. If a property pays for itself, it doesn't hurt your borrowing capacity as much. You can buy one, then buy another, then buy a third. You build momentum. You use those high-yield properties as stepping stones. Once you have a strong cash flow foundation and a pile of equity, then you can come back and buy that blue-chip Melbourne trophy asset when the market confirms it is moving. However, if you're determined to buy in Melbourne, perhaps you want a future home for your children, or you just have immense faith in the CBD, you must go in with your eyes wide open. You need a sleep-at-night buffer. Do not calculate your budget based on today's income. Calculate it based on worst-case scenario income. Can you afford the land tax hikes? Can you afford the special levies? Can you afford to fix the heater to meet the new minimum standards? And realize that the Victorian government is the X factor here. Will they repeal the land tax if the government changes? History suggests no. Governments rarely give back revenue streams once they have secured them. In fact, given the debt levels in Victoria, it is more likely they will invent new taxes than repeal old ones. Let's summarize the strategy. If you're in the accumulation phase, trying to get from 0 properties to 5 properties in the next 10 years, Melbourne is a dangerous play right now. It is a heavy anchor that will drag your ship down. The negative cash flow will kill your serviceability, and the stagnation will kill your equity growth in the short to medium term. If you're a high net worth individual looking to park cash for 20 years and you don't care about the monthly bills, then Melbourne is a bargain. It's on sale. But for the 99% of us trying to escape the rat race, we need velocity of money. We need assets that work for us, not assets that we have to work for. Don't let FOMO dictate your strategy. Just because the news says Melbourne is due for a boom doesn't mean your bank account can survive the wait for that boom to arrive. Investing is about the numbers, not the narrative. And right now, the numbers in Melbourne are screaming, proceed with extreme caution. That's all for this episode. I want you to look at your portfolio today. Are you holding assets that are feeding you or eating you? It might be time to make some tough decisions. Thanks for listening, and see you next time.